Morning, everybody. Welcome to another market report brought to you by Mike Bjork. Today is Friday, April 29th. I hope you guys got some great upcoming plans. Happy Friday. Hey, we got a lot of data to go over today, so we're going to jump right into it. And we'll start off with the Employment Cost Index. This is basically an index that kind of gauges on the cost of employer to hire people here. And as you can see, it was 0.6% in the first quarter all the way across the board. So previous quarter was at 0.6%. Previous reading in the forecast was 0.6. It came in at 0.6%. So this is something you definitely want to keep an eye on, primarily because this can bleed into our inflationary numbers, the costs. A lot of it due to the salaries and benefits and everything else. We also got personal income. As you can see, we had the previous month in February 0.1% increase, so almost nil, and it came in at forecast of 0.4%. So people are making more money, but on the other hand, we see people not spending money. So as you can see, consumer spending, we had people spending more in February than we did in March. We had 0.2%, and the forecast was supposed to continue at 0.2%. It came out measly 0.1%. So this is some numbers kind of keep an eye on, because this is going to lead to some probably negative views for a second quarter, where if people aren't spending money, how's the economy going to recover or at least continue to grow? Inflation numbers. We got the core PCE. This is the Fed's favorite gauge for inflation. And the previous reporting in February was at 0.2%. We thought it would be basically nil in March, and it came in at 0.1%. So it's still very little. That actually dropped our year-over-year over a 12-month period from inflation number from 1.7 down to 1.6%. The Fed is trying to get this up to 2% level. On this, and this is some of the that if this maintains itself at a low standard, this is going to be one of the variables that I think will keep rates low for a while. Why you may not even see the Fed even raising rates this year. We got the Chicago PMI. This is manufacturing in the Chicago region. On this type of gauge, anything above 50 is considered expansion. Anything below is contraction. We had saw a spike for about a month or two, and then the East Coast we saw a dip. So same thing in Chicago. We're seeing 53.6 back, so some expansion in March, but it dipped in April and just barely above being into the contraction levels at 50.4. So again, this is something that we've been watching to see, because when the dollar strengthens, it's harder for us exports, and that hurts manufacturing. So when we raise the rates back in December, manufacturing can potentially take a hit. The dollar was stronger. But some of the things that have been going on recently with the Bank of Japan not creating more stimulus, the dollar's been getting kind of weaker towards the yen. And as a result, you're starting to see oil prices going up. The dollar's getting kind of weaker as a result. And oil prices are going up because it's pegged to the dollar as a result. So that's why we're seeing oil prices spike up a little bit over the last month or so. Consumer sentiment. Previous reporting, we have an initial one earlier in the month, and we have a final in April. We had an 89.7 initial one, and we thought it would go up a little bit. It actually dipped down to 89, so people weren't feeling as rosy at the end of the month as they were beginning of the month. Right now, stock market's down. They're still kind of reeling in from yesterday's news, as well as more disappointing data that came out, earnings reports. So Apple was a big surprise to a lot of investors. It's their first quarterly loss they've had in 13 years. And then on top of it, you got Carl Icahn basically selling his shares in Apple, addressing the concerns of China, where they're not getting that market because there's a lot less expensive phones there. And then on top of it, you got some of the poor data that came out of recently. And of course, Japan's central bank did not do anything. They're kind of put on hold, it says. Excuse me. Oil, it did spike up to about 46. So right now it's down a little bit, because it did by the end of the day yesterday. Even though we were about 45 in the morning, it did go up to 46. But for the day, it's down to about 45. You know, it's up to about $46 here. So bond market, we're up. We had a nice little spike, as you can see, late in the day yesterday, and we started the day off earlier. We started down further and then worked our way back up. Currently, we're about 3 basis points where we left off on yesterday. But because there's no price change or anything, you're going to see better pricing coming in this morning. So I think you'll see overall better pricing. Now, if we can get above this resistance level here, as you can see, this will become a floor support for us, and we can continue to get better rates here, at least get back to where we were a couple of weeks ago here. All right, folks. Hey, have a wonderful week, and we'll see you guys next week. Hopefully, you're able to get some good information today. But look forward to see you guys next week. Thanks for watching. Have a good day. Bye-bye.